presentation about Silicon Valley today. It's going to be about the Silicon Valley collapse. My name is Benson Kwan.
My name is Yusuf.
My name is Maria.
My name is Ere.
Jacob.
Right? And this is about our agenda. What we're going to be talking about is going to be over the background of what's going on, of what Silicon Valley was, what happened to it, reasons and consequences of the collapse, and the reaction of customers and the bankers of it, and then a little bit of the job security. So a little bit of the background. It was founded in 1983 by two Wells Fargo's banker and one Stanford professor, Roger Smith and Bill Biggerstaff being the two Wells Fargo, and then Robert Medeiros being the Stanford professor. And it started because it was like in the Silicon Valley area, they had a lot of innovative minds at the time, and they needed capital to get their stuff up and running. So they created Silicon Valley Bank to help them out. And at first, Silicon Valley Bank only financed the tech companies, the emerging tech companies. And with that, they quickly became like a big bank that everyone like kind of trusted, and they went globally with it. And because of that, a lot of new companies and bigger companies trusted them and partnered with them, including Apple, Cisco, Google, and a bunch of other companies, and then they became a leading provider in the innovation economy. And with that, something happened to them recently, as I'm sure all of you know by now, and Yusuf is gonna be talking about that.
Cool. So just to give you guys like a broad timeline of what happened. So SVB mainly invests in like government securities, like treasury bonds, stuff like that, which are generally like pretty safe investments, like low risks, but like kind of low returns, but they're pretty safe generally. But within the last year, the interest rates have gone through the roof to combat inflation. That doesn't work out so well for government securities, because when the Federal Reserve raise interest rates, those new bonds that become available have way better returns compared to the ones they initially bought. So new investors prefer those, which brought their value of their bonds down. So a few like tech companies had to withdraw like pretty large amounts of money that the bank didn't have. So they were forced to sell those bonds that they had at a loss. So on March the 8th, which is like a Wednesday, the bank announced that they had a $1.8 billion loss on their bond portfolio, and they additionally wanted to sell some stock to raise an additional $2.5 billion to cover those withdrawals that the tech companies were trying to get. So when the following day after that, when people started to see that they needed to raise all this money, they freaked out. Like when the stock market opened the next day on the 9th, their stock like completely crashed. So like if you look at this graph right here, you see like the cliff that it just tanks. So that following day on the 9th, there was an attempted total of $42 billion to be withdrawn, which they didn't have, so collapsed. So yeah, within 2 days, the whole bank just collapsed. So Maria's going to talk to you about some of the consequences of that.
Okay. So as Joseph explained, some of the reasons of the collapse were the share value from technology companies fell and the aggressive rise in interest rates. I'm going to be talking about some of the consequences. The first one is the FDIC, the intervention of the FDIC, which is the Federal Deposit Insurance Corporation, which is a government agency that's been around since the Great Depression, and what they do is they insure most of the banks in case of what's going on right now, but only for $250,000. So if you have an account with more money, which in this case for Silicon Valley Bank, more 60% of the accounts were more than this amount, you're just gonna get the insurance for this money. And then hundreds of startups facing a cash crunch. Startups don't have access to their funds, so they will have trouble with everyday businesses expenses, including payrolls. And also one of the first consequences was like the financial services in the bank with their clients. So they offer services such as lending, cash management, and investment, and it hard for clients to find a new bank that has the same services in such a short time. And also they have the need to find a new buyer. And now Ariel is gonna talk about the reactions of consumers.
Thank you, Maria. So after the collapse of this bank, there was a loss of confidence in the banking system, but more especially on the small banks. And some individuals decided to move their money out of banks and invest it in other assets or just hold it as cash. But small banks had a drop of $108 billion. Meanwhile, that there was an increase in large banks deposits, and this created a inverse relationship where funds were being transferred from small banks because they were starting to be not trustworthy to larger corporations like Citibank, Wells Fargo, Chase, you name it. And as this information can be seen in the graph, because there was an increase of 1.1% in deposits for large banks, meanwhile that there was a drop of almost 2% in deposit for small banks. And if we see it in the perspective of percentage, it might be not that significant. However, if we see it in the monetary perspective, we're talking about billions of dollars and that are being transferred from smaller institutions to larger institutions. And now we will continue with Jacob that will talk about job security.
So obviously with the collapse of the banks and businesses that are going to be suffering, there's going to be a massive amount of layoffs. So some of the companies include Facebook, Amazon, Google. They all have announced layoffs following the collapse of the bank. Workers are starting to prioritize job security and starting to lean towards the smaller companies that provide more job security, like startups and so forth and so on. The tech teams are starting to lean out. Big tech teams such as Facebook is laying off 20,000 people this year and probably another 20,000 next year because they're trying to lean out those tech teams. In addition to that, there was obviously late wages, which has something to do with job security. Late wages that followed with the bank crashing. Most of those late fees that the companies were supposed to pay have been waived because they were not obviously given a heads up about the crash. In addition to that, people have taken upwards of 10 to 20% pay cuts in the jobs that they're currently working in. And I will pass this back off to Gabriel for the conclusion.
Okay, in summary, or finalizing, all this collapse happened because of high interest, and because of that high interest, the bonds or the value of the bonds dropped. And they had to sell those bonds, and they had to announce a $1.8 billion loss. And that created a massive fear around customers, investors, everyone. And this fear caused individuals to take their money out and make a bank run. And after the bank run, the FDIC took over, which made the aftermath or the reaction of other banks or customers to move money from these small banks that target, that have a specific target like Silicon Bank, that target tech companies, to bigger banks and more, quote, safer banks. And lastly, this created a loss of jobs. Thank you guys for your attention.
Okay, 9 minutes and 10 seconds. It's a pretty good use of time. Good job on the time. All right, what did you like about the presentation?